conventional wisdom, it's always good to invest in property. But the way the real estate market has been going, not many of us are completely convinced at the moment. Buying a property and making sure it generates regular income is a Herculean task in these times. However, there is a way to invest in real estate that guarantees regular returns without you having to go through the hassle of actually having to manage the property. And that is called as REITs, or Real Estate Investment Trusts. What exactly is it, and should you go for it? These are the 9 things that you need to know about REITs before you make a decision. Number 1. REITs, or real estate investment trusts, are just like mutual funds where investors come together pooling their money to buy a portfolio of assets. While in the case of mutual funds, the asset being bought could be either equity or debt or gold, in the case of REITs, the asset being bought is property. But just like mutual funds, in REITs too, the assets are professionally managed by a designated manager to ensure regular income generation and capital appreciation as well. Number 2. The concept of REITs originated in the United States of America way back in the 1960s. But it is fairly new when it comes to India, because the first guidelines for real estate investment trust was given by SEBI only in 2007, and the first REIT eventually hit the market just a couple of years ago. Number 3. Just like mutual funds, REITs in India follow a 3-tier structure. There is the sponsor responsible for raising the capital. This is typically a real estate company that owned the assets or the properties prior to the creation of the REIT. Now, the sponsor is mandated to hold 25% of all REIT units for the first 3 years after the creation of the REIT. Post that, this can be reduced to 15% of total outstanding REITs units. Then there is the manager who is responsible for selecting and operating the properties and ensuring timely reporting and disclosure by the REIT. Now, the manager of a REIT is typically a facilities management company. And then there is the trustee. The trustee holds all the assets of the REIT in a trusteeship for the benefit of the unit holders. The trustee is also responsible for overseeing the activities of the manager and ensuring timely distribution of dividends to investors. In other parts of the world, REITs can invest in any income-generating properties, residences, offices, malls, hotels, etc. But in India, the REITs that are listed focus only on office properties. And SEBI guidelines mandate that 80% of a REIT's portfolio needs to be invested in completed and rent-generating properties. Number 5. There are exactly 3 REITs available for investment in India: Embassy Office Parks REIT, Mindspace Business Parks REIT, and Brookfield India Real Estate Trust. But more REITs are expected to hit the market, with big names in the real estate business like DLF and Godrej having expressed interest to bring out their own REIT. Number 6. SEBI recently brought down the minimum investment amount limit for REITs from 50,000 rupees to just 10 to 15,000 rupees, with the trading lot size of the units being reduced from 200 to just 1. This means that you can start investing in real estate with a much smaller sum of money, and your investment is not restricted to one property in one location, but rather a diversified real estate portfolio that covers different locations. Number 7. Unlike plain vanilla property investments, REITs come with a mandate to generate regular income. They have to distribute 90%, that's 90% of their income to unit holders in the form of dividends or interest income or both. So far, over the last couple of years, Indian REITs have been distributing dividend and interest income to investors every quarter. Number 8. In India, it is compulsory for REITs to be listed on the stock exchanges. Now, as they're being traded, the price of the individual REIT units changes depending upon their performance as well as market demand. Just like stocks and mutual funds, a good performance by a REIT results in an increase in the individual REIT unit price, which you as an investor can leverage by selling at a profit and pocketing some cool capital gains. And finally, number 9. While there are many intrinsic advantages to the REITs, there are many risks attached to them as well. For instance, Indian REITs are mostly focused on office properties. But with work from home now becoming the new reality, demand for office space has taken a massive hit. The taxation on REITs is also rather cumbersome when compared to other fixed income investments. And most importantly, the returns from REITs so far have been similar to the yields on safe bonds or post office savings schemes. For more videos like this, subscribe to our YouTube channel. You can also follow us across all social media platforms: Facebook, Twitter, Instagram, and LinkedIn. @Money9Live is our handle. You can also log on to our website www.money9.com for all the latest from the world of personal finance. Thank you for watching. Keep it with Money9.